In terms of rates, obviously when it jumped up to 4%, that pushed rates up towards 5% and over.
Oh, yeah, well, nearly 6.5. 2-year fixed.
But tracking back down now?
Yeah. Best rate today is 3.75, which is
375.
Yeah.
So they're losing money.
no,
Lending it.
no, not 5-year fixed at 3.75. They'll have sliced the margins, but swap rates are sort of 3.02 or sort of thing. So there's still a margin there.
Yeah, I mean, so in terms of this year and rates, obviously they jumped up. They seem to be tracking back down now. Are you expecting? What are you thinking for the year?
The general consensus in the market is that rates will continue to come down slowly. I know they went up quickly.
Yeah.
But the reason for that was a loss of confidence in the wholesale money markets, in what Liz Truss was proposing. The reason they won't come down quickly is because there's no one lender wants to, if you like, stick their head above the parapet, and then find that their service is underwater.
Yeah.
So everybody's coming down bit, and it's probable, to answer your question, that sort of towards the end of this year, you may see something starting with a 2.
Okay.
But the new normal is expected to be between, I think, 2.5 and 4, depending on your loan to value.
Yeah. So fixing
credit
in
score
the
and
early
so on.
3s at the beginning of the year was perfect.
Fixing is going to be the way forward regardless.
Yeah.
Because tracker rates are linked to Bank of England base, and that possibly hasn't finished.
Yeah.
Because inflation isn't where they want it to be. Although I've seen 2 forecasts this week suggest, one from the Bank of England and one from Citibank, both suggesting that they think that inflation will be 2% by the end of the year. And I can tell you the rest of the market thinks that's optimistic. However, early 2024 is perhaps more realistic.
Okay.
So,
That's encouraging.
And that should then mean that base rates come back down again.
Yeah.
But again, I don't think anybody should expect 5-year fixed rates or sort of under 1% as they were for a short period. So the new normal probably somewhere between 2 and 4%, depending on your loan to value and your credit and all the rest of it.
And that's, historically, that's still cheap.
Still very, very good.
Isn't it?
Yeah, absolutely.
Yeah.
So I think
A lot of the commentators, they're saying about mass repossessions, the crash of the market.
no, and again, I would completely ignore the media on that one, because I can tell you that mortgage lenders are fully funded. They want to lend. They've all got increased lending targets for this year. And because mortgage underwriting has been stress tested at between 7 and 8% for the last 5 years, there's no big arrears, sort of problem coming. And because of that, confidence remains, and high loan to values are sort of, out there and possible.
Yeah.
Anything under 5% is generally good, but I would think that sort of 3.5, maybe even sort of 2.99, you could see that this year.
That's cheap.
Yeah.
It really is. No, it's interesting because we do see a lot of buyers expecting this crash in values because of them. All the stats, they tend to be national.
Yeah, but it is. That's what I'm saying. It isn't. The thing is, the main purpose of newspapers is to sell newspapers.
Yeah.
And you see, even in the so-called respectable press, the headlines are supposed to catch you a bit like clickbait. Then you read it, and then it's not quite what they're telling you.
No.
And you guys, if you read an article on anything that you know a lot about, you're going to read that and go, well, that's rubbish. Or, well, they've really slanted that.
Yeah.
You know what? I'm pretty sure they do that for everything.
Yeah, they do.
Of course, yeah.
But it's amazing how that noise does create turbulence and concern.
Oh, that's it.
Oh, no, you can. Yeah, absolutely. You can be the architect of your own downfall if you want to.
Yeah, people can. And I mean, in terms of some tips and advice for a potential client thinking of making a purchase this year,
If you can afford it, do it now. Because the property market isn't, and you know more than I do, but at the moment everything I read, suggests that it's going to probably stay flat this year.
Yeah.
No crash.
Yeah.
Probably start to go up again next year. And first and foremost, for most of the people we're talking to, it's not an investment, they're buying a home.
Yeah.
So if it's the right property for you and your family, and you can afford it, do it.
Yeah.
Yeah.
But dare I say it, family homes over the mid to long term, they always tend to be a cracking investment.
They do, but the thing is also most mortgages are not. You're not having the same rate for 25 years or 30 years.
Yeah.
You're having the same rate for a couple of years, and
Yeah.
then you review. And if the trend for mortgage rates is downwards, as it is, you might sign up for 4% today, but in 2 years' time you might sign up for 3%.
Yeah.
So you're constantly reviewing in order to try and have the best deal you can, and that's a big part of what we do for our clients.
Yeah.
Is that we're in contact with them, regularly reviewing their mortgage and other financial arrangements.
Yeah.
And the expectation currently in the market is that in 2 years' time, mortgage rates will be lower than they are today.
Yeah. So in terms of,
But house prices will be higher.
they certainly will.
Yeah, they will.
And so you'd be suggesting probably look to fix for 2 years. It gives you that certainty that you're not paying the tracker rates.
It also has to do with the client's attitude to risk.
Yeah.
If they're more cautious and they look at 4% and say, well, I can afford that, and I don't want to run the risk of it going higher,
Yeah.
then you might fix for longer, 5 years
Yeah.
or 7 years or 10 years, and you can do that. People have.
Yeah.
And certainly, if you wanted to go back 20 years and someone said to you, do you want a 10-year fixed rate of 4%, they'd have ripped your arm off.
Yeah, they would. Yeah.
So it just depends on the context of the market.
Yeah.
Wish I fixed mine for 10.
Yeah. I know. It's,
And what products at the moment? Which lender? What's the best you're seeing at the moment? Who's favourable in terms of lending?
Well, it's a constantly competitive market, Simon. So whoever's got the best this week,
Will be different.
it'll be somebody different next
Yeah,
week. Because
sure.
again, lenders are always looking to make their targets and lend more money,
Yeah.
and do that by coming out with marginally better products than their competitors. And obviously, there's different lenders have different USPs. So for somebody who's self-employed, one lender might be better than another than somebody who's employed. So there's 150 lenders and something like 15,000 mortgage schemes or mortgage products out there.
but would you say in general that the difference is you're talking marginal rather than there's significant variation?
You can say marginal, but if you have £1 million mortgage and 0.5% difference, it's
Yes.
substantial.
That's it.
Yeah.
If you've got a £100,000 mortgage, maybe not so much.
Yeah, but are you seeing a 0.5% swing?
Oh yeah. No, there is. I did some research for a client this morning. Fairstone as a business are large enough to be able to get exclusive rates with lenders, and one national lender is offering us a 2-year fixed rate that is 0.45 better than they're offering to the market. Again, it's for a specific area, so you have to have at least 40% equity.
Yeah.
So it'll be that end of the market, but
Yeah.
100%.
So it is.
No, as I said, go back to your original point. If someone's in the market and they want to, they're thinking of moving, then if they find the right property and afford it, then I would absolutely say go for it.
Yeah.
Because it's a long-term thing anyway. And what happens if you miss out on it because you think you might if you wait?
I need you to speak to all our buyers. But again, I think vast majority of people, it is search for the house, find the house you like, then worry about financing.
Yeah,
For me, it's go around, make sure you know cast iron, I can afford that.
Oh yes, definitely. And in fact, again with the developers we work with, they won't let you in the door unless you've done that.
Yeah.
So absolutely, you should work out your spending power before you get in the car.
Certainly from our side with buyers, it's always advising actually get your ducks in a row and the finances and solicitors and all of those assets to it, so that when you do find that house, because stock is lower, you want to be in the best position because it is going to be your family home. You don't want to miss out because someone else is more organised.
Yeah, 100%. So commit to it.
Yeah, absolutely.
Don't do it half measures otherwise.
But it's great. We always say it. It's the biggest purchase most people certainly make it in any given year.
Yeah.
And then that amount of time people spend on it is, you probably spend more time choosing your new car or new curtains or something. But
Well,
it's always been that way.
How much of that is to do with the amount of time you have to walk around a place?
Yeah,
Yeah.
people don't spend.
They don't spend half enough time.
I'm not sure we want people spending hours and hours and hours and hours coming back to the houses,
But it is true. It's the biggest purchase would be in people's lives, and you only spend
10 minutes in there.
just to look around.
15 if it's a big house.
Yeah. Depends how good the agent is.
But no, if they come back, if they come back 4 times, they're not buying it.
Yeah.
Because then there's things they're obviously worried
Trying to
and
find.
thinking about. But it's, you see people spend 10 minutes in a house.
Yeah, I'll take it.
Yeah. That's 5 million quid.
Yeah, we like those people.
Yeah. No, I think it would always be like that.